I've been doing this for about 20 years, a little history on myself. I started out a long time ago with a very small mom and shop, little broker shop. And then I went to big banking, went right into Chase, put on the white shirt and the blue tie. And I was in big banking for several years until I went to Countrywide, who was probably one of our biggest correspondent lenders. I think everyone remembers Countrywide, right? And we remember what happened with Countrywide. Countrywide then became Bank of America, so that I was still in the big banking world. But why I say this is because I learned something from each one of these industries. I went from a small mom and pop broker shop where I learned literally what the left side and the right side of a file was, because that's how we did it. And then I learned on the banking world their overlying guidelines, who they were servicing with, who they were selling loans to, and took that information and decided about 2 years ago to finally go out on my own. And the reason that I did that is because I needed more solutions. I have clients, like many of you in the room, that are self-employed or have just become self-employed or are W-2'd and don't know that they're self-employed. Which you run into that a lot in my industry. So I needed more solutions. So now being that I am both a broker, how you doing, Jay? We're both broker and correspondent. That means I have 75 different investors with over 500 boxes that I can fit somebody into. The challenge, and nothing against the big banking world, you've got one box. And if you don't fit that one box, you have to find a solution. So, power of choice. The reason I call this power of choice is because we're giving our clients the power of choice now. It's not, hey, I need this, 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 and this, and that's all I need, and if you don't have it, you don't qualify. Well, in this world now, we have one-year bank statements, conforming and jumbo loans, and a bank statement qualifier. What that means is if someone comes to me and says, hey, I'm self-employed, but I only incorporated last year, but I've been in this industry for 5 years, then I can take a one-year tax return for that client, hopefully the highest net tax return, most recent, and use a one-year tax return to qualify that client. I don't have to go back and do a 2-year. And with us right now, being that we're just coming out of this pandemic, a lot of folks lost a lot of money during the pandemic. So that year does not look good on paper, but there's a reason for it, right? Being whatever they did for a living, whether it's meeting with people face to face, well, obviously that wasn't going to happen. So how do we kick that year out and say, look, this was not one of my average years? Well, we do a one-year tax return loan for those folks. We also have 3 to 12-month bank statement cash qualifiers. What that means is after looking at tax returns and we know that they're net, after all their write-offs, they're just not going to qualify. And trust me, I've seen folks that have 0 on their tax returns, right? Then we're going to look at a bank statement type of qualification for them where we're literally going to use the bank statements to qualify this person. We're going to look at the deposits that are coming in, and we're going to use those deposits as just like it was their actual income and use that to qualify someone. Asset to income depletion up to 6% or divided by total portfolio. What that means is we can literally take their assets, we can do a depletion on those assets and use that to offset income. So let's say we have a W-2 position and we have one customer or we have a client co-borrower that's self-employed. We have our W-2, but we have to hit for the self-employment, which is negative. I can take their assets and use it as a depletion, literally take a percentage of their assets and turn it into income on paper only to help them qualify again. Okay? Debt to income ratio up to 55%. We can actually go a little bit higher than 55%. And what this is, a debt to income ratio is basically, it's kind of my verbiage, but a loan is a number. People are not. But a loan's a number. And if you go above a certain ratio, it becomes more and more difficult to qualify, right? Because we've got to be able to sell these loans. And that's where people look at it and go, do they have the ability to repay this loan? 55 is a high risk type of factor. On VA loans, the only reason I bring this up because it's not in the slide, on VA loans we can go as high as 70, 80%, just depending on what our underwriting factor finds, okay? So, all right, and then IR pension income, one distribution needed for income. So I've been doing a lot of these type of loans. This is where someone has an IRA in place. They may be of retirement age. Maybe they just have money market accounts. What we can do is we can actually show a distribution from that account, again on paper, for the purpose of qualifying for a mortgage. It's kind of hard for me to say because we used to not be able to say that. Because you couldn't just qualify someone with income to qualify for a mortgage. Now you can. So for the purpose of qualifying for a mortgage, we can literally show distributions from their SEP IRA and use that on paper only to qualify them for income. Because at the end of the day, we know that you can afford it, right? We're still giving you a loan. You've got to be able to afford the payments on the loan. We can show that this is the way that you could afford it, okay? P&L for income, unaudited P&L used for 1 year business income. The reason that I list this is it comes back to our 1 year statement for self-employed. A lot of folks will ask for, and what investors have asked for in the past, and a lot of the big banks will ask for, is they'll ask for a P&L. If they say they need an audited P&L, guys, you might as well just file your tax returns. Because an audited P&L is just that. It has to go to the IRS and they have to look at it. We're able to put a P&L in place for someone to not have it audited, and that's huge in my world, and Mike probably knows that as well. So it's a time constraint in how we can alleviate some pain for people. Pension distributions, that goes into our into the IRA and the pension. Schedule E rentals, gross income, expenses, and depreciation. What that means is if we're looking at someone who wants to invest, and we're looking at their Schedule E. How you doing, Mike? Then we can build that Schedule E rental back into their tax return, okay? This one here is a big one, DSCR. I know you guys have heard me mention in the past DSCR. We're talking a lot about that. That is debt servicing ratio. What that means is if we're looking at someone purchasing an investment property, it used to be for commercial properties, where the property is basically qualifying itself. Well, now we can do that on residential, and that's unheard of. We can actually do that up to 4 units. So now if someone wants to buy an investment property, and before they had to come in and spill all their tax returns and everything and go, John, how do we figure this out? I want to build my portfolio. How can I buy this property? Well, now we have to try to qualify on the rents, and then we have to bring in the tax returns. Now the property qualifies itself, and you can do that with as little as 20% down. All right, so power of choice, asset solution. So we talked a little bit about that. So when we're looking at turning, if we don't have enough assets or we need to use assets for down payment, but we also need reserves, business funds down and reserves are allowed. So you can literally use your business funds. This is also something that's changed in this market. It used to be that someone would go, well, I own my own business and I have all my monies in my business. And that's what I want to use for my down payment. I want to use it for closing costs. I want to use it for reserve. We used to have to tell folks no. Now I don't, because I have investors who will accept it, okay? Jumbo gift funds, up to 100% for down. So I just did this for a client, and actually the reason I added this is because we were at 95%. What this means is now if somebody has, let's say, unseasoned funds, and they have transfers into a bank account, I have a lot of folks that are in the cash business. They'll take money from their business account and they'll take it in cash and put it into their personal account. It used to be that we can't use those. Now we can, as long as it's being shown as a gift. What that means is that we take those funds and we put them into a different account. They wire the funds directly to escrow, and those are now considered gift funds. And that can be done 100% of the down payment. They don't have to season those funds, okay? So if people are in the cash market and they're putting a lot of cash into their bank account, now we can actually source those funds by turning them into a gift. Let's get past property. So how much time do I have? Okay, fantastic. All right. So creative solutions. This is where we really set ourselves apart from, say, our big banks. Nothing against them, but we have to have power of choice and we have to have creative solutions. So LLC blind trust vesting allowed. That's where we take an LLC or a trust. Again, for someone that is self-employed, we can put a trust in place, use that trust as a blanket that protects their assets, but now we can turn those assets into income for the purpose of qualifying for a loan. Did I lose everybody? So yeah. So whoosh! Basically, and a lot of folks will say, well, John, I don't want to take my money and put it into a trust. Well, you're not putting your funds into a trust. You're developing a trust to protect what you already have, which I highly, highly recommend, even if you're not purchasing a home. But by doing this, what we can do is we can take a portion of that trust, let's say it's $10,000, and we take that $10,000 and we put it into our personal account. Well, as long as the balance in our account will support those deposits over a 3-year period, well, guess what? I just turned it into income for the purpose of qualifying for a loan, okay? We do this a lot with folks right now because a lot of folks have a lot of reserves, a lot of cash, but again, they're not showing what we need on the tax return, or they're negative on the tax return. This way I don't even have to bring a tax return into play at all. Okay? And we can do that up to a max loan amount of $10 million with some of my investors. Non-occupant co-borrower full blended ratio, no required UTI for occupant. Basically, if we have someone that we need as like a co-borrower on a loan, we don't need to have them qualify for that. We do HELOCs up to 90%, and interest only is allowed on any one of these type of LLC or blind trust vesting, okay? So again, just another way to get creative. And the bigger advantage, so folks out there that are that don't know where we're at right now on our loan limits. So here's the thing, rates have gone up. There's not a lot of properties out there right now, right? There's not a lot of inventory. But what happens is when we run into this type of market where prices keep going up, then we have to change our county loan limits. It's one thing that we're very good about in California. So our new Orange County loan limits right now are up to $970,800. What that means is somebody can come in and buy a house with a loan amount of $978,000 and put as little as 5% down today. Again, have to get creative, right? So, and what, I mean, the average listing right now is over $1 million, it seems like, to me, from what I see come across my desk right now, okay? So increase our values, higher loan limits, which means more opportunity lending with less money down, so people can still buy their homes. And then tap into home equity. The reason we want to mention this is because right now, the average homeowner out there right now has about $153,000 in available home equity. I'm not kidding. We did a survey on this. We took a look. And most of the folks that own homes will have this amount of equity. What can you do with that equity? Well, right now you can still consolidate debt, build an access dwelling unit. Boy, those are popular. ADUs, right? I get more and more calls today about folks that want to build ADUs. You're going to call me about the ADU? Okay, all right. Pay off student loans, pay off your debt, remodel your home, or use the equity to increase your portfolio by more real estate. Yes, absolutely. Use that equity. Use that equity while you have it and buy more real estate, because who knows how long the value is going to keep going up, right? Happy birthday to you. All right, and then for you dreamers out there, choose your dream home. So larger loans with lower down payment. I have 10% down payments up to $3 million on loan amounts right now. 25% down payments up to $5 million, and 30% down payments up to $7 million, and that's actually up to $10 million right now. So any of your dreamers out there that want to buy a $10 million home, come see me, and we can make that work.
You like those loans?
Absolutely. And then, hey, I'll tell you what, I think I would rather do a $100,000 loan than a $10 million loan. Because, yeah. To me, a loan is a loan. So, but interest only and stated income is available on any one of these type of programs, okay? So a lot of folks will think, hey, you know, I'm going to be stuck in a 30-year fixed. You know, I have to show all my tax returns today. I just won't qualify. That's not reality, okay? So thank you very much. That is my presentation. We'll open it up for any questions, and hopefully I can answer.
So
yes.
How does one, you had talked about a strategy for someone that you have to combat the cash buyer, you know, and so you're going to have, let's say, 5 or 10% down, and you had a strategy of like, we're going to be able to put money aside and go in as a cash buyer, but you're actually financing it.
So come in as a cash buyer. So what we do is we actually do what we call a 14-day close guarantee now. So that's where someone has sent all their documentation. We do a very quick underwrite on those folks, because you can't really come in and say, hey, I'm a cash buyer, and then not be a cash buyer. I've seen it before, and the listing side really doesn't like that, because you're kind of, you know, you're kind of playing the game. But by closing in 14 days, that's basically the same as coming in with all cash. Because in California, under RESPA rules, we can't really close less than 14 days. You can try to close in less than 14. So by establishing that, we're kind of competing with all cash. And then we also do what we call no loan contingencies. When we send out an approval letter, there'll be no contingencies for our loan. And that means we're basically just putting our John Hancock on there saying, yes, we're going to go ahead and get this loan done for someone. So that's about as close as cash as we can get. So, make sense?
Yeah.
All right, sir. Yes, ma'am.
I'm really glad you explained that
Absolutely.
I have a question. If you put less than 20% down, like the 5% example, do you need to put that back in insurance or not do that?
That's a great question. So no, we can actually do up to 95% loan to value, so putting 5% down with no mortgage insurance. Yeah. All right. Mr. Mike.
On the investment property, residential, that the property qualifies for itself and the income.
Yeah.
Do they take the gross rents and then they 45% haircut and then use that 75% number?
So what they do is they actually take the rent ratio is what they do. So they do a rent roll, an AVM, and they'll look at it, and as long as the property debt services itself by 1%, then it will qualify. Yeah.
That's different.
That is different. Absolutely. Yeah. Yeah. All right. Any other questions?
Thanks.
Yeah. Thank you very much.